Okay, welcome. So this is the straight audio of the mixtape that I prepared. Now the link should be in the link for the website should be in the description of this website. So a view to a mill is the name of the mixtape, and we go in a clockwise direction. So we're gonna follow this mind map in a clockwise direction. Okay. Now the mind map is on the website. So we start at beliefs, and it's important to understand that we our beliefs are not reality. We don't live in reality. We only live in our beliefs are our filters for what reality actually is. But we still have to operate in this world. We still have to make decisions. So we can only make decisions based on our beliefs. Our beliefs that our parents handed down to us, our upbringing, our community, the church, religion, what God is. So we can only trade our beliefs. So there's reality and there's our reality. And the best systems try to marry the two. And so you want to always enter a trade or think about trading in terms of here's what I think reality is, and reality will show us. So the best systems are robust enough to work within based on our reality and what reality is. That's where risk management comes into force. So you need to understand that live in we do not our beliefs do not represent reality. They only represent our filters to what reality is. So the stock market, when you think about the stock market, historically, the stock market, if you were to put your money, your spare money from a 9 to 5 into the stock market and left it historically from say the 1960s all the way here, your blue chip stocks and stuff, factoring in the ups and downs, the long return of the stock market has been about 7%, 7 to 8%, something like that. So this has led a lot of financial advisors. This is filtered down from financial advisors to say, okay, look, put your money in the stock market, and over a long period of time, you will eke out 7 to 8%. Now, as a swing trader, we don't really follow that. We want to make money from price swings, money in, money out. Ideally, between anything from 3 days all the way up to months, really, and we're looking for returns of at least 10 to 30% a year. So annualized return. Now, stock trading is not for the weak, not for the weak minded. That's why 95% of traders don't make money. Okay, so we need these principles, these fundamental principles that we're going to go through um, in this course now. I created a mixtape, just having a bit of fun. But at the end of the day, these are the building blocks that we're going to use moving forward for this portfolio builder, the basic version, and obviously for the advanced portfolio builder. Now, so you need a system, and you need a system based on your beliefs that allows you to analyze the market, so either on a technical basis or on a fundamental basis. Technicals are really your bells and whistles, your signals, your charts, your patterns, um, and fundamentals. You do have patterns in fundamentals like economic cycles and things, but those are more to do with the company performance on a balance sheet and whether they have crack team board members or have made innovations, products, and things. So those are really the two forms of analysis. But we're really just trying to get down to the grassroots of what is reality. And as long as you understand that your beliefs are not reality, they only represent your reality, then you you're kind of more healthy, and you're in a dance of my reality and reality. So you build a system between the two, bridging the two, you should be okay. Um, so what is the market? Well, the market, um, generally speaking, are baskets of stock indices. So indices, I describe them as like baskets of stocks. So when you're in major cities, so in London or the UK, you have the FTSE 100. That those are the 100 largest traded stocks in the UK. Then if you were to go to Japan, you'd have the Nikkei 225. So 225 companies, largest in Japan, traded on the stock market. And in America, you have a lot more liquidity, a lot more variety. So you have the NASDAQ 100. These are the 100 largest tech stocks. You have the S&P 500 and the Dow 30. These are like your blue chip, old school, um, large companies. Um, so, and what it is about these is these give you an indication of what the economy is doing. So I tend to look at them over like a 6 month period. So if you type in Google Nasdaq 100, you'll see a chart, or S&P 500, you'll see a chart. And you can select the chart to show you 6 months. So I tend to look at 6 months, and if the value today is higher than the value it was 6 months ago, then that tells me that the stock market, as far as those indices are concerned, is trending up. And if the value is lower today than it was 6 months ago, it tells me that those indices, those stocks in those indices are trending down. And economists tend to use the term bull or bear market. So a bull market is a trending up market, and a bear market is a trending down market, or choppy down. Now, so this is what we want. We want trends. We want to trade trends, because differences in movement, that's where we make our money as a swing trader, position trader. So we want trends. We want to know when a market is trending and in what direction, because the indices, they represent the big wave. These are the biggest companies, the big institutional money, the pension funds, the insurance funds. They are flush with cash every month. Think about it. Your pension goes into these companies every month. Your 401k goes into these companies every month, and they're flush with cash every month. So they have to, and they put it into the stock market and other places, but mainly the stock market. So where these big institutional fund managers, where they choose to put their money, is where the big wave is. So if the indices are going up, it means the certain companies within the indices are, money's going in. So the big wave, the stocks are going up. Now the stocks represent the little waves. The individual stocks represent the little waves. The big wave is the indices, and the stocks within these indices are the little waves. So most of these are going to follow the big wave. Some are going to try to butt against it and move against the wave, but the majority are going to move with the big wave. So we want to usually trend with the big wave. Follow the big money, to trade with the big money. We want to ride the big wave, because your little dinky boat, your little dinky account, we want to ride with the big wave. So when we're picking stocks, we want to generally move in the market direction, the indices, the big wave direction. We want to pick a stock that's moving in that direction also, and ideally on that day we want the stock to be moving in that same direction. So everything's just on the surf, just moving in that direction. So to do this, we're going to need some tools, and the one of the first tools is your price chart. Okay, now you want to look at this on a laptop, not on a phone. You want to look at your price chart on a laptop so that you can see things clearly. And when we look at a price chart, I don't get too much into like technicals, because I like to keep things real simple. There are, on the price chart, what you'll notice is that the prices move up and down. Okay, now if it's moving in a trend, it tends to move up and down, but I look at a daily chart. So each each bar on the chart represents 1 day. So I do the editing for the chart so I can see, because of the time zone we're dealing with, swing trading. I tend to look at a year, and so you've got 12 months, and what you'll see is you'll see that each bar on the chart like this represents a day, 1 day. And you'll notice that some days are up, some days are down, some days are up, some days are down, and it moves in a zigzag pattern in a general direction. So it might trend sideways in a zigzag pattern, it might trend up in a zigzag pattern, it might trend down. And what you'll also notice as it's moving in its zigzag pattern is it may go up, and then it may settle at a certain price and then move down and then settle at a certain price and turn around and then go up and then hit a certain price and then come down. And it might do that if it does it more than once, more than twice, and it repeats it and turns around at round about the same price. We tend to say it's either resisting moving up and then it turns around, or it's resisting going down and then turns around. So these become what are called resistance and support levels. And once again, these are not real. They're more psychological. They're more psychological than real. They don't really have much meaning, but they mean something to traders because everyone's looking at these patterns and they recognize that, oh my gosh, the price is turning around here. So these kind of help us make decisions on where to buy and where to limit our risk. And now I'll get into that a little bit more later. But generally speaking, you want to recognize support and resistance levels on a price chart. And you're either trending up, trending down, or kind of moving sideways. So I tend to use what are called candlesticks because they're just a lot easier to look at. They tend to look like this. So when they're trending down, they're red, and when they're going up, so I can visually see, down, up, down, up. Now, so that's the first tool, is the price chart. The second tool we look at is called the average true range. And here's what the average true range is. First, we look at the true range. So if you have a stock at price of 10, but during the day it has gone up to 9 and then it's gone down to 11. It's gone up to 11 and it's gone down to 9 and then it's settled at 10. Well, what's the range for that day? The range is 9 and 11. So the range is 2. Now, if you were to follow that stock for 14 days or 10 days, right? So let's say 14 days, and it had a range of 2, 2.5, 1.5, right? If you added all those up and then divided it by 14, you'd get the 14-day average true range. Okay, and let's just say, for argument's sake, that's 2. So the ATR, the 14-day ATR, average true range, is 2. Okay, so that's really what the average true range is. Now, why is the average true range important? It's important for the next tool. And the next tool that we use is really the start of our protecting our capital, protecting our money. And that is called the stop loss. And the stop loss, the way to explain it is, if we were to enter a stock at 10 and we say, well, I'm going to enter at 10, but if it reaches, say, 8, I'm out. I don't want it to go down I don't want to be involved for it to go down anymore. So our stop loss would have a size of 2, right? So that's protecting our capital up to that level. Now, the average true range is important because it tells us the range of, do you remember when we were looking at the price chart, the zigzag movement? Well, that ATR is giving us the range of that stock movement, not only like within every day, but just generally speaking, the range of its movement. So we can use the ATR to kind of set our stop sizes. Now, why is the stop loss size important? It's important for a few reasons. Now, if we want a stock to move, if we're looking at a stock and we want it to be moving in a certain direction, we want to give it enough wiggle room so that it's doing its zigzag thing, but we're still in the position. And so we want the stock to be, before it takes off, it's gonna wiggle a bit, it's gonna go up and down. So we want to be in that position long enough for it to to take off. Now, but at the same time, you want to set your stop size so that once it does move, we still have some level of reward for the risk we're taking. So, for example, if a stock is at 10, we could set our stop loss at 1.5. Okay, but remember the ATR is about at 2, so it's more likely to hit our stop and take us out of the move. But if we set our stop loss at 3, we can kind of absorb those movements, the two size movements, before the stock takes off. But you have to think about it this way. If a stock is, say, at 10 and it goes to 15, right? If our stop size is 1.5 and it goes to 15, how many 1.5s are there before it gets to 15? About 3, right? Because once it gets to 14.5, that's 3 lots of 1.5, right? That's a 3 to 1. Yeah, so the risk is 1.5. The reward is 3 and a bit. Yeah, so 3 to 1 winner. But if we were to set the stop loss at 3 and it gets to 15, well, there's only one set of 3 that will take it to 13. So that's a 1 to 1 and some change. So it's a 1.5. So it's a 1 to 1.6 or something, right? If it gets to 15. So you always want to think of your stop losses. You don't want them too short, because you'll get stopped out most likely, and you don't want them too wide because it will kind of take away from the reward that you can make. So that's why the ATR is important, because we want enough wiggle room, but we don't want it too wide. So that's the first part of our protecting our capital is a stop loss. The second part of protecting our capital is the how much. How many shares do we buy? Now, the first thing you want to think about is you will have losing streaks. I don't care who you are. I don't care how perfect you feel your system is. You will have losing streaks, and it's important to think about drawdowns. So, put really shortly, if your account, so let's say you have 100,000 and it drops down to 90,000, you need to make 11.11% just to get back to break even. And if your account dropped down to 50,000, you need to make 100% return just to get back to break even. So when you think about drawdowns, you want to avoid this kind of situation. Okay, how can I avoid a situation where I have to produce superhuman returns just to get to break even? So that's where position sizing comes in, because position sizing allows us to eat some losses, but at the same time stay competitive, so we can make some wins. When we do make some wins, we get over the edge and still can produce above average returns. So I use a percentage based model. Shout out to best coach, rest in peace, Dr. Van K. Tharp. Okay, it's one of his books here, Super Trader. So I use a percentage based model. When I learned about this, it changed my trading trajectory. And what it is you look at your account as a total and you say, okay, I'm only going to risk anything from 0.25%. You can choose your percent, anything from 0.225% all the way up to, some people say 2%, 3%. But me, 1% max, if that. And it's based on your confidence, how confident you feel about your system. But really, I think it's more intelligent to think about it in terms of the drawdown. So if you were to take 10 straight losses, what percent do you want to arrive at? So if you're risking 0.25%, if you had 10 losses in a row, what's that? It's just shy of 2.5%. Okay? You're still there. You're still there for another round, for the 11th round, with some heat. So I look at the percentage like that. I set the percentage like that. Can I eat 10 losses and still, and still be fire, And the way we work out the number of shares is we take our total account. So let's say your account is 100,000, divide it by the percent that you want to use. So for ease, we'll say 1%. So 100,000 divided by 0.01 will give you 1,000. And you divide that by your stop loss size. So divide that percentage risk to your stop loss size, and that will give you the number of shares that you'll buy of that particular stock. So we've got the tools. We're looking at the charts. We know how to set our stop losses. We know the average true range, the size of the stops, and we know how much we're going to invest. So now we're in the investment. We're in the trade. How do we take our profits? Well, number one rule of trading is the one rule to rule them all is cut your losses short and let your profits run. So how do we let our profits run? Well, the stop losses are going to automatically take out our losses. So that will happen automatically. But what about when it starts moving in your direction? Now, this is another place that the ATR, the average true range, comes into effect. Multiply your average true range by 3. Okay. Now, over time, you can move around this multiple, but multiply it by 3. So when the stock now moves up, you bought it at 10 and it moves up, let's say it gets to 18, right? The ATR, it might be 2. So the ATR is 2, multiply 2 by 3 is 6. So when the stock starts to move up from 10, we're going to be trailing the stock by 6. Okay? So I want to give it a lot of wiggle room. Okay? So it means we won't always catch it at the highest point. We'll catch it on its way down, but we will always give it enough room to keep trending and hopefully shoot for the moon. Okay, so that's our trailing stop. Now, what happens? All of these fundamentals, I mean, that's pretty much it, but all of these fundamentals, they lead to what I call the portfolio builder. Now, you've got the basic portfolio builder on the website. The description is the website name is in the description below. So you've got the complete basic portfolio builder. And to give you an idea of what happens over time with a portfolio builder, your losses will come first. There's no other way of putting it, but your losses will come first. And what will happen is you'll be taking losses. You'll be getting stopped out. The main reason for that is because the winners take time to grow. Think about it. If you've entered 10 stocks all on the same day, okay, and 2 of them are winners, well, how long is it going to take for those winners to actually grow? Meanwhile, you're taking loss after loss after loss, but these losses are limited. They're limited by your stops, right? But the winners, remember, you're trailing them, and they're going to take time to grow. So you can have a look at the chart on the My Map, okay, should be on the screen, and you can see that the winners come later, but the winners are larger, tend to be larger than your losses. Okay, and this is the crux of it. So you're letting your winners run and you're cutting your losses short. So for example, out of 20 completed trades, you might have 6 winners, okay, and 14 losses. But the size of your winners are so big that your account is profitable. Now, how does that translate in your account? And the first thing I'm going to tell you is you're going to run out of money. It's happened to me 4 times, okay, in my trading career. You're going to run out of money. And the reason for this is what happens is, so let's say your account starts at 100,000 and you start placing trades, okay? Remember, you're holding on to winners. You're holding on to them. And the losses are being made, right? But every time you make a loss, it frees up some cash. And then you have to now reinvest that cash into a new trade. But over time, you're going to find winners that you're holding. So your capital, your capital is always going down, right? But your equity, that's the value of your total investments and your capital, is going up because you're holding on to winners. Eventually, you're going to run out of cash unless you are injecting new cash in, either through investors or through your work. Okay. Now I started using prop firms, so I don't have that problem anymore of running out of like cash to invest. But when you're trading your own money, you are going to run out of capital. It's just if you're trading right, it's just gonna happen because the ones that you're holding, you're not selling them because you're just holding them. You know, they're moving in the right direction, and you're not gonna have any more capital unless you liquidate some, but you're breaking your rule of letting the profits run. So how can you test the system out? Well, most brokers, can give you a demo account, so you can get started straight away for free, and you can test the ideas and practice. But the only thing to remember is it's going to be different from a real account eventually, because your emotions are only involved when your real money is on the line. So you need to bear that in mind and start trading for real. Like, use small percentages. Now, you now know how to limit your risk, but that's essentially it. You can get started for free. You can get started from today. Open a demo account, online demo account, and just start trading the big trends. So there is a basic portfolio builder once again, and yeah, those are the fundamentals. Yeah, enjoy this. I hope you enjoyed this video. You can like and subscribe, and I hope to see you soon. Speak to you soon. All right.